Are you interested in investing in multifamily real estate? Multifamily is a terrific asset with a lot of benefits, but I see people making the same mistakes over and over again. In this video, I'm going to cover the top 5 mistakes I see people making when it comes to multifamily investing. So make sure you hit the subscribe button right now so you don't miss more videos about building wealth through multifamily real estate. And if you don't know me, I'm Seth Ferguson, a 13-year real estate veteran, host of a real estate TV show, host of a real estate investing podcast, and I'm also the author of the real estate book, Sell for More. So let's get right into it and talk about the top 5 mistakes people make when it comes to multifamily. And first things first, today is a great day. The reason why, I got a haircut after 2.5 months of Corona shutdown. So the mop is gone. I feel like a new man. Today is a good day. So let's get right into these top 5 mistakes. Mistake number 1 has to do with underwriting. Specifically, being too aggressive with your underwriting. And if you're not sure what underwriting means, it's simply the modeling that you do when it comes to the investment opportunity with all of your market assumptions and your forecasting for that opportunity and that property. So people are too aggressive in 3 main components. Number 1 is appreciation. We all know that we as investors cannot control how the market appreciates. We can control the property, how the property looks, the operation of the property through our value add business plan. And if you're not sure what the value add business plan is, or if you want to learn more about it, I'll put a link right up here to the value add video I did talking specifically about that subject. We can't control appreciation, but we control a whole lot of other things. But where people get it wrong is they actually are too aggressive with the appreciation they're plugging in to their Excel spreadsheets or whichever program you're using. Some people will actually bank on the market appreciating 6% a year for the next 5 years. That is a little bit too generous. We always want to err on the side of caution and really scale back our appreciation forecast, because appreciation may or may not happen. We want to focus on what we can control. If you're banking on the market appreciating at 6% a year, 7% a year, even 5% a year, chances are you are being far too aggressive because you can't control it. The market could stall and go flat. If you in your modeling are assuming that cap rates will be lower, so more compressed, maybe 100 basis points lower than when you purchase the property, you're being far too aggressive. One should always assume that the market will be softer, so cap rates will be higher when you go to sell or divest of the property, because we always want to plan for a worst case scenario. And if the market does appreciate even more, cap rates do compress, well, it's a great day and it's an added bonus. But when we're working on our underwriting, there is a big difference between plugging the numbers on a spreadsheet and then actually making it happen in real life. It's far too easy to plug in rosy numbers when you're analyzing a property, especially when you're competing against multiple offers. But you really have to stay disciplined and realize that, even though you can change a percentage point on the spreadsheet, making that happen in real life is a totally different story and it's a lot harder to do. So always be more conservative and don't bank on appreciation. The second point I want to touch on is rents. Far too many people overestimate the upside when it comes to rents. Maybe you are assuming in your underwriting that there is a $200 premium that you can capture through your renovations, but in reality, the market will only support $150 per unit or $125 per unit. You really have to know exactly what the market is today when you're acquiring the property and underwriting it and evaluating the opportunity. Make sure you are making apples to apples comparisons. Don't be comparing a 90s build to a 2010 build property and saying that is a good market comparable. You are only cheating yourself and your investors if you're underwriting that way and being far too aggressive. You should always scale back, and let's say you are thinking that there is a $150 upside per unit. Well, use $100 or $125. Always go less than what you think the market is, and that way you will not be disappointed if something happens or if you can't achieve that rent premium you were gunning for. The third thing to watch out for when it comes to underwriting is refis or refinances. Where people get too aggressive is when they build refinances into their underwriting modeling and they make it seem like it is a fact that will happen. Markets can change, situations can change, refinances may or may not happen. So if you're building into your underwriting that a refinance will happen in year 3 and you will return 100% of investor capital, well, you are being far too aggressive because there is no guarantee that will actually happen. And by removing that refi, that's going to skew everything else in your underwriting and your modeling. And chances are you will not hit the targets that you led your investors to expect through your spreadsheets and your underwriting. So if you are planning on going after a refi after your value add plan is finished, well, that's great, but leave it as an extra, as a bonus, as a welcome surprise at the end. Don't build it into your underwriting because so many things can happen and you're treating it as a fact, but we all know the future is uncertain and we have no idea what will happen. So when it comes to underwriting, be more conservative. Don't bank on too much appreciation. Make sure you have market rents down to a T. Don't overestimate the upside, and then do not build in refis into your initial underwriting. They are always treated as an extra bonus. Mistake number 2 has to do with rehab and renos. On my podcast and TV show, I have guests on who are experts in the construction management field, and they always say, almost every single one tells me that the number 1 mistake people make is not knowing their true numbers when it comes to construction, rehab, and renovation. The mistake people make is they're walking through a deal maybe with their property manager, maybe with their partner, and they just guesstimate a per unit cost for the rehab, for the construction at, let's say, $20,000 a door. The number 1 mistake construction managers highlight is people not knowing their true numbers. You cannot just make up a blanket statement, an all-encompassing number per door of $20,000 without actually going through and itemizing exactly what needs to happen. So having a true handle on your construction rehab costs is essential. As so many people underestimate it and then they're left, they run into cash flow issues. They have to raise more capital to come in and finish the renovation project. Make sure that from the start you are walking through with somebody who has the construction management experience with that type of asset, who can give you real numbers based on fact, not from just guesstimations from walking in and just taking a peek at a couple units. And coupled with rehab and renovations is downtime. I've seen where people do a tremendous job, a bang-up job, figuring out a conservative appreciation, working on market rents, not working in refis. Everything is good here. They buy the property at the right price, but they forget that as they're doing these renovations and rehabs, nobody's paying rent in those units because it's empty. Their underwriting looks perfect, but maybe a unit is going to be down for 3 months. But they haven't factored that in, and they're still assuming in their spreadsheets that somebody's paying the rent. And what happens if you have 5 units down at the same time and they're down for 3 months apiece? Well, that's a whole lot of rent not being paid, and unless you actually work that in and build that into your underwriting, you're going to be showing cash flow on your spreadsheet that isn't really there. So always make sure that when you're doing renovations and banking on having units down, extend it for longer than you think you'll need to, especially with coronavirus. Coronavirus was a good example of banking on delays in terms of a construction project. Construction sites shut down, renovations had to stop. If you are assuming that a unit's going to be down for a month and a half, in your underwriting, put down 3 months. Work out 3 months of no cash flow coming from that unit, because delays always happen no matter the construction project. There are always surprises that happen as soon as you start doing any type of work. So always overestimate the amount of time it's going to take, and I would rather overestimate the cost rather than underestimate, because nobody wants to be in the position of having to raise more capital once you've already closed on the deal to finish off renovations. Mistake number 3 has to do with raising capital. A mistake I see a lot of capital raisers make when they first get started is they'll go out, speak with their investor database about a potential opportunity, and as soon as they get soft commitments up to, let's say they need to raise $5 million. They'll talk with their investors, they'll get soft commitments, so verbal commitments from a whole bunch of investors saying, yeah, I'll invest X amount. That totals $5 million. And they think, oh, great, I've got my soft commitments, I've raised enough capital, I can go out and acquire the deal and the money will be there. Well, reality will soon set in, and pretty soon that capital raiser will find out that even though those investors said they will invest $5 million, only a small portion of those investors will actually fund the deal, because things at life happens, other opportunities happen. Maybe the investor needs money for something else. Maybe they had a change of circumstances. So whenever you're raising capital, always oversubscribe, always raise more than you think you'll need. So if you need to raise $10 million, raise $20 or $30 million, because anybody who's raised capital before will tell you that things get in the way with the investors. Life does happen like it does with everybody else. So if you're raising capital and you need to raise a certain amount, always double, triple, the more the better. Never bank on just soft commitments, because you can't rely on just a soft commitment. You have to rely on hard money when it's wired into your entity's account, ready for closing. That is the only capital that you can count on. Number 4 is debt. We all know that bad debt can sink a great deal. So it's really important to have the right kind of debt. And what I want to talk to you today is about the term of the debt. So we talked about value add a little bit, and I put the link for the video up there for somebody who wants to learn more about the value add process. So let's say you are in your underwriting, you're assuming a 4 to 5 year hold for you to implement your business plan and then put yourself in a position to sell once you've hit your return target. What a lot of beginners do is they'll say, okay, well, I want to sell in year 4. So then when they go out and acquire debt, they'll just acquire a debt with a 5-year term. This is a very, very poor decision, because nobody knows what the market's going to be like in year 4 and year 5. So you've basically handcuffed yourself that you have to sell, because let's say the market takes a dive and it's the worst selling market that we've seen in the past 100 years. So the world is ending, you can't sell, nobody wants to finance the deal. Your term is running out, you are in your last year, nobody wants to finance you. What happens? Well, you have to sell at that point, and nobody wants to be placed in the position where you have a gun to your head and you are forced to sell because you can't refinance and get different debt on the property. The buyers, the market will chew you up and spit you out so fast, and there goes all your investor returns and all your hard work over the past 4 to 5 years. So when we're talking about debt and the term of the debt, always go for more than you really need. So if you're planning on a 4 to 5 year hold, get a 10-year term on your debt. That gives you, if a worst case scenario happens and you can't sell because of market conditions or unforeseen circumstances, you can hold for another 5 years until conditions improve. You are not pressured to sell. Your investor's money is safe. You're able to hold the asset that's producing cash flow that you have manufactured through your value add process. You are not under pressure to sell and make poor decisions. Where poor decisions happen is when you have extreme pressure, whether it's a financial pressure. You don't want to be placed in that situation, and you don't want to place yourself and your investors in that position. So when you're looking at debt and considering your options, always go for a lot more than you really need, because that's going to buy you time if something does happen. Like I've said a couple times in this video, nobody knows what the future will bring. Nobody has a crystal ball, so always be conservative. That is the theme of this video. Be conservative in your approach, in your underwriting, be conservative in your debt terms, and that way you are planning for a worst case scenario. And mistake number 5, we have partners and partnerships. If you're interested in improving your underwriting, if you want to have a better handle on construction and rehab, if you want to raise more capital, improve your capital raising skills, do a better job at assessing debt, and do partnerships better, like I'll talk about in a little bit, I want you to come out to the Multifamily Conference next year in 2022. It's being held May 14th and 15th in Toronto. We've got investors coming from all over North America. We have a star from Shark Tank, as a keynote speaker, go to multifamilyconference.ca. I really hope to see you there. It's going to be an amazing event, everything to do with multifamily. So let's talk about partners and partnerships. The mistake people make is everybody thinks when they first get started, they have to do things on their own. And that's a mistake I made when I first started investing in real estate. The truth is, multifamily real estate especially is a team sport. It takes a team to effectively take down and manage and turn over a multifamily deal. So partnerships can come in many different forms. Partners can bring capital. Maybe you need $10 million to complete a deal, you can only raise 5. Well, instead of passing on that opportunity, partner up with somebody else who can bring in the other 5 million, and both of you can prosper and benefit from having that deal get done rather than not having that deal in the first place. So partners can be especially helpful when it comes to raising capital. Construction, rehab. Like I talked about here, having a handle on rehab and renovations is especially important. If you don't have those skills, partner with somebody who does. Trust me, the project will go so much smoother. Your investors will be in better hands. The project's going to be on time. Your modeling is going to be much more accurate because you have somebody with the experience on your team guiding you. So partner up with somebody with construction management experience if you don't have it. And maybe you need deal flow. Maybe you have lots of capital that needs to be placed, but you don't have the deal flow. Well, somebody out there has the deal, but they need the capital. That is a great partnership. And like I said before, both of you can get together, make that deal happen rather than not have a deal on your own. So partnerships are incredibly powerful. And so many people don't think about getting involved in a partnership because they're thinking like I was when I first started investing, just assuming that you have to do everything on your own. So these are the top 5 mistakes people are making: being far too aggressive with their underwriting, not having a handle on their construction and rehab, not raising enough capital or getting enough soft commitments for the capital they need, having the wrong debt terms, putting themselves in a bad spot in case something does happen in the market, and not exploring partnership opportunities. And if you are an accredited investor and you're interested in learning more about the deals I'm currently looking at, head on over to callseth.com and set up a free 20-minute phone call with me. And if you liked this video, I hope you did, hit the like button, leave a comment, let me know what you think. It really helps out the channel, and this channel is growing thanks to you, so I really appreciate it. And until next time, happy investing.